Elon Musk and the CFPB. Breaking news. Elon wants the CFPB terminated. Is this going to be his first big act under his Department of Government Efficiency? Don't hold your breath. And here's why. Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Yo, what's popping?
A lot of things are popping, John.
What's
a
that?
lot of things.
Not the thermostat, Dustin.
No, it is cold as shit in
it's
here.
not bad. It's like 62.
Dude, I love this weather. We are in Central Florida. It is December. Holy cow. It is December, and I get to wear a sweater.
What's the temperature in your house? Because you said you don't turn on the heat. So what we're sitting at, a brisk 68 in the Owen household?
Yeah, somewhere around 68 to 71. It's great. My poor daughter upstairs where she lives. That's what, anyone who has teenagers, they understand that. Like, I don't go upstairs unless I have to. But yeah, upstairs where she lives is probably 65 and she complains. And the other day my wife said, you know what, I'm going to go upstairs and turn the heat on for her. I said, you better not.
To what?
It doesn't matter. I told her not to do it.
Yeah,
she can put a blanket on.
It is, but so, yeah, I agree. I can turn
but-
mine on. It's at 71 right now. So
Yeah, but it is cold in our office, in our studio today, which luckily with the lights, it actually warms
it
up
does
in the
warm
studio.
up. It does warm up.
But no, there's a lot going on. So, I mean, obviously the election's behind us, and you did a great job of producing an episode where we talked about life post-election, especially as it pertained to mortgage and real estate. And yeah, shout out to our friends over at Housing Wire. Because,
Shout out Housing Wire.
Dude, I love me some Housing Wire, right?
How much are you paying them to fucking see them articles?
I'm not paying them anything.
That's called organic exposure, Dustin.
You
That's
know what
a
it
big
is, though?
Deal.
I mean, look, shout out to Diego and Clayton
shout out
and
to
Zeb and Sarah and literally the whole entire team over at Housing Wire. No, it's naturally my favorite publication, right? As a mortgage and real estate professional, Housing Wire is one of my favorite publications, if not the favorite. I read it daily, and I have religiously for at least the past 5 years. And like anything, if I like it a lot, then I'm going to use it. I'm going to talk about it. I'm going to reference it. I'm going to go to their events. Because I dig what they do. And I think the love that they're showing back to TLOP may be in the same vein of, look, they dig what we do.
Oh, yeah.
And we're kind of in the same space, but we're kind of not.
Right.
You know, I joke and I dream about the day that Clayton's going to come in and buy us.
I keep saying it. I think you've said it now in 7 episodes.
I told it to Clayton when we were out in Denver. I said, hey, Clayton, man, when are you going to buy us?
And he laughed and he said, what's your name again? And that's when the conversation was over.
And just like that, the ADM party bus came and picked me up and took me to the Katy Perry concert. And that's where that story begins.
Ends, right?
No, not ends. That's where
it begins.
No, you said what's popping. We got a lot going on. First and foremost, I have like lots of shout outs I need to give. We'll make them quick. But shout out to Atlantic Trust Mortgage, aka ATM. That's Scott, that's Wade, that's Kayla, that's the entire crew at Atlantic Trust Mortgage in Jacksonville. They invited me up and to Jacksonville, which that's about a 2-hour drive. Luckily for me, what I do, took a bunch of phone calls. Right, so I hammered out calls on the drive up. I hammered out calls on the drive back. So that means I spent 4 hours prospecting. So if you're my boss, Craig Montgomery, and you're tuning in right now, or if you're the founders of Lower, Dan Snyder and Mike Baines, please know I spent 4 hours yesterday prospecting on behalf of Lower. I need them to hear that.
I can chop that up into a promo and just send it directly to Dan at Lower. You know I will. He'd be like, who the fuck? Jake, like, who is this guy?
But no, shout out to that crew because I went up there and I actually facilitated, some would say performed, but facilitated my business planning workshop in person. And what was really cool is I did it for about 15 people. We did it at a badass bowling alley, believe it or not. Bowling alley with like conference rooms. So we had the conference room. They had food brought in. We did 2025 business planning. Then we bowled 2 games.
With pizza?
The pizza,
conference room? Or you talking about them
wings?
fucking party rooms for 7-year-olds in the back?
It was a conference room because it had an HDMI cable and I could plug in my laptop.
And that's automatically makes it goes from a kid's room
to a conference room, just like that. But if you are a mortgage originator, you're a branch manager, you run a company the way that Scott and Wade run a company, please know I would love to do business planning. I might not be able to physically come to your location or a bowling alley nearest you, but that's why we have webinars. Or that's why we have the TLOP community. So if you're a part of the TLOP community, whether you're paying or you're not paying, we'd love you to pay, by the way.
Yeah.
But whether you're paying or not paying, I will be conducting on December 12th a business planning workshop, and we're going to be doing it via Zoom. So it's going to be free. It's going to be free. It's our way of, giving back. It's the holiday season, and we want to provide for our TLOP community. So again, if you're a producer in the mortgage industry and you have not done your 2025 business planning, I invite you to be a part of our workshop on December 12th. Just go to our website, tloponline.com, and you can register right there. Speaking of like events, check this out.
Okay.
So business planning December 12th, that's going to be just a webinar, probably going to have several hundred RSVP, a couple hundred are going to hop on. But then in January, shout out to our friends at Eustis Mortgage.
Shout out Eustis
right?
Mortgage.
Jake Airy, Kate DeKay, the rest of the crew. I get to travel to New Orleans in January to participate in their annual sales rally. So I'm pretty stoked about that. So that's January. We roll into February. That's Mortgage Con.
Shit.
So I'm going to be speaking at Mortgage Con. They have people like Barry Habib speaking at Mortgage Con. Like, you should see this lineup, right? It is just back to back to back, packed full of some of the who's who, biggest thought leaders in the industry, those men and women who represent the future of mortgage lending. We all are going to be participating in Mortgage Con. It's being held at Universal Studios in Orlando, February 4th through 7th. That information should be on tloponline.com, or you can just Google Mortgage Con 2025. That's February. Then in March, we get to go participate in the Kentucky Mortgage Bankers Association.
Is it Kentucky Derby?
It's not Kentucky Derby time, but it is going to be in Louisville. Like, we can still go to Louisville, as they say.
You can go where they make the baseball bats. That'll be.
I've been where they make the baseball bats. It's actually a really cool museum, and it's a cool experience. But I'm going to go and I'm going to enjoy some whiskey. I'm probably going to go to try to hang out with some of our buddies, Jason Parker, Mitch Florence.
Yeah.
Yep. Try to maybe get people like Haley to come down from Cincinnati, be a part of the event, get to hang out, meet, and what do the kids call it, in real life, right? So that's going to be a really cool event happening in March that I'm going to be there keynoting and presenting. And then in April, I get to do what I did for Kentucky. I get to do it now in Iowa. Get to go hang out with our friends in Iowa, and it's going to be the Iowa Mortgage Bankers Association having their event. That's how we're kicking off 2025, John.
Do you see how we increased the production level of the podcast already?
Already?
Just because you have your little stenographer, what do you call it? Your teleprompter.
Well, you don't need to tell people that I'm actually like
Why?
using
I'm
something
proud,
to keep
Dustin.
me.
You said you want to get 1% better. This is us being intentional and getting 1% better.
All right, I'm going to get 1% worse. Check this out.
Oh, God.
Check this out. I was today years old. We call you JC.
Yeah.
Okay, do you know who else they call JC?
Jesus Christ.
Yes.
Are you
Yes.
Get away
Yes.
from me, man. Why are you such a dad?
People are like, Jesus Christ, you teased us with
JC.
Elon Musk. You teased us with Elon Musk and the CFPB, and you guys haven't shut up yet.
You haven't shut up yet.
All right, you keep talking then. Why
I
don't you
don't
take
know.
over
No,
the show?
I'll look over your notes. All right. I'll go in order. This is me preparing for a
Please
test.
do not.
All right. Hey, everyone. I'm
Can
here
you
to
even read my handwriting?
chicken scratch. I'm here today to talk to you about, I think Elon Musk has a new position within the government because he's boys with your boy. So Dodd-Frank, July 10. I'm serious. I'm reading Dustin's notes. The CFPB, July 11. Mulvaney, Kirchner, and Chopra will be there. Listen, they all proposed to get Warren to get rid of this. Elon Musk might get rid of the CFPB, the stability, financial stability. So, Dustin, what questions do you have for me?
That's the episode.
I'm serious. If I were the brains behind this show, that's what it would sound like.
We could end this episode quickly. Ready? Ask me the question. Hey, Dio, do you feel like, in your professional opinion, will Elon Musk shut down the Consumer Financial Protection Bureau, the CFPB? Just ask me the question.
Dustin, do you think Elon Musk will shut down the CFPB in his new role in the government?
No. All right, so check this out. Today's episode, we know that there is a new sheriff in town, and this new sheriff is bringing its posse. as by the way happens every 4 to 8 years, or every 4 years, but it's 8 if they got reelected. But every time we have a change in leadership, that leadership is going to want to bring their people. I mean, you see it even in corporate America, right? You see it in college athletics. My school was successfully able to convince our head football coach to leave. And when that dude leaves, there will be some people who follow him.
Nut huggers is what I call them.
And then the new dude will come in, and that dude will bring some of his own people. So, there's nothing wrong with a president who comes in and says, all right, cool, I'm cleaning house. I don't want the other dude's people. I want my people. And they start putting in their people. And they start trying to put in their policies. Then they want to try to get their policies enacted into law, right? That's just kind of how the world works. So one of the initiatives of the Trump administration is to create a Department of Government Efficiency, or Doge, D-O-G-E.
Like Dogecoin?
Just like Dogecoin. Gee, funny how you did that, John. And there's been 2 people that have been anointed or appointed or chosen
Knighted
to co-lead this Department of Government Efficiency.
Okay. Who them people are?
Well, one is Vivek. Can never pronounce his last name. He actually ran for president this year. He ran through the Republican primary, and obviously he didn't make it through the primary because Donald Trump was selected to be the candidate for the Republicans, and he won the election. But Vivek, it's like Swamy. Please, I butcher names easily. Don't hold it against me. The other one's an easier name, and it's more of a household name, Elon Musk. Okay, so
a Twitter guy.
Yeah, a very eccentric. Yes.
Never heard of him.
Innovator, entrepreneur, computer programmer.
Shout out the original Tesla, like the human, not the company.
Yes. Well, he didn't found Tesla. He bought Tesla.
Yeah, I know, but that's why I said shout out to the OG Tesla, like Nikola Tesla. I see you, OG.
Yep. Pretty sure he made his money in Yahoo, but he didn't found
Bitcoin.
Yahoo. No.
Who?
Musk.
Never heard of him.
Okay. Anyhow. So for those that have heard of Elon Musk, mostly I've heard of them usually through Tesla. Maybe you knew of him prior to Tesla. And then obviously he's doing his stuff with SpaceX as well. So he's going to come in, and the Department of Government Efficiency, like on paper, looks like, oh, cool, efficiency. What does that mean? Let's figure out where we're wasting money, and let's stop wasting money. That's essentially, on a very high level, what the attempt is going to be. Now, it could terminate a bunch of government workers. It could get rid of a bunch of departments that once it's done, we as a society say, oh, wait a minute, why did we do that? No, we shouldn't have done that, but only time will tell. That's not what this episode's about. This episode's purely about, it's in the trade publications, and we actually had a viewer and a longtime supporter reach out. Shout out to Amber, by the way. Reach out and said, Dio, you should do an episode on this. I'm like, hell yeah, we should do an episode on this. So, and her question was, do you think that Elon Musk is going to have success shutting down the CFPB? Because Musk is saying out loud that the first thing he's going to do is he's going to shut down the CFPB. Well, if he did that, that impacts the mortgage industry. That impacts the consumers that the mortgage industry serves, at which point that's the content that we create through our channels. So
that CFPB, it regulates more than just mortgage stuff?
Yes, the CFPB regulates, let's see here, payday loans, credit cards. They regulate the servicing of debt. So, probably student loans would be put into that. For-profit education would be put into that. So, yeah, the CFPB is the Consumer Financial Protection Bureau.
Gotcha.
So it does a lot more than just regulate the mortgage industry, but it regulates the fuck out of the mortgage industry. Right. Okay, so it is a big deal. So we need to address, like, what if this were to happen, or do we think this would happen? But I think before we do that, we have to understand, like, well, how did the CFPB come about? Because a lot of our viewers, a lot of the mortgage professionals and the home buyers that tune in to our show, they were in high school in 2008. Heck, some of them may have been literally in the second grade in 2008 when the market collapsed. I don't know if we have any listeners, hardcore listeners, viewers that were born in 2008. No, because that would make him only 16 years old.
That's Troy Holm.
To Troy Holmes, shout out to our boy Troy. T. Roy. No. T. Roy was actually probably born a lot closer to, I would say, 2000 or 1998. No. Yeah, he's not.
He's a 2000 baby.
No, he's a 1998 baby, I guess. Anyhow, let's get down that. Let's get off of that rabbit hole. Let's not digress any further, John. JC. The other JC.
Yeah, right.
But no, so in 2008 is when the financial collapse happened, right? The Great Recession happened, and it was primarily due to a housing bubble bursting. That housing bubble was created due to unregulated industry, unregulated mortgage originators, unregulated Wall Street, banks that were too big to fail, and they became too big to fail because there were very loose, some would say lackadaisical guardrails. I mean, back then, you literally could pay a ratings agency
Really?
to give you a AAA rating.
That's awesome. Let's get back to those days.
Yeah, well, I mean, but then we see the aftermath of what happened.
Right.
And I think what we're trying to do is prevent, as a society, that collapse from ever happening. Like, if you ever want to know how dire it was back in 2008, go read Hank Paulson. So Henry Paulson was the Secretary of the Treasury at the time. Go read Hank Paulson's firsthand account of those 9 months of how he and a handful of other really experienced, super bright financial professionals held our shit together. And not just ours, not just the U.S., but the world economy and what they had to do through government intervention, by the way, right? Through throwing out life rafts and bailouts. But it was either that or something that none of us wanted to truly have to live through and experience, which would have been financial Armageddon. So the reason for the CFPB was because of what we lived through in 2008. The CFPB came out of the Dodd-Frank Act. The Dodd-Frank Act, and that's Barney Frank and Chris Dodd. Barney Frank was a congressman from Massachusetts, Democrat, by the way. Chris Dodd, another Democrat, and he was a senator from, I believe, Connecticut. Good pizza in Connecticut.
Good pizza.
Yep. Good lobster rolls in Massachusetts.
I don't eat lobster.
Okay. Well, that's what you get. And I don't know if a lot of people know this. In fact, it wasn't until recently that I thought Dodd-Frank was bipartisan. I thought it was one Republican and one Democrat getting together to put together the Dodd-Frank Act. And no, it was two Democrats that came together. The idea, check this out, the idea for the Dodd-Frank Act actually came from a Harvard law professor by the name of Elizabeth Warren. And today, Elizabeth Warren is a very popular, outspoken, and high-ranking senator from the state of Massachusetts. Yeah, but at the time, 2010, she was a Harvard law professor, and she proposed that we need more controls, more regulation, more guardrails to keep from the 2008 from ever being able to happen again. So it was through the Dodd-Frank Act that the CFPB was created. So Dodd-Frank Act came into law, I believe, in July of 2010. And then it was by July of 2011 that we had the CFPB. And the CFPB has a director. That director is appointed by the president. Now, the courts have recently said that the president can also remove the director, right? So it's not like a federal judge. Like, once you become a federal judge, you're not being removed unless you did something really bad to screw it up. Like, it's a lifetime appointment. The CFPB is not a lifetime appointment. It's appointed by the president. It is also someone that can be removed by the president. Like the Federal Reserve chairman, that the Federal Reserve is supposed to be nonpartisan. Therefore, I do not believe that a president can actually remove a federal chairperson.
Clarify, the Federal Reserve actually has no government oversight. It's a private entity, Dustin. So therefore, that's where we are
by
today.
Theory.
I will not delve more into it because I like living my life.
Okay. Perfect. I'm picking up what you're putting down.
Yeah.
So Richard Cordroy was the first, and he came in and he meant business. When Trump was president, meaning the first time through, he put Mick Mulvaney in, and Mulvaney was the exact opposite of Cordroy. Mulvaney did his stint until he let Kathy Kraninger come in and take over. And then when Trump lost the 2020 election, then the Biden administration put Rohit, or Director Chopra, in. So Chopra has been the current acting director or director of the CFPB. But with a new administration that's going to come into power in January of next year, we will be getting a new director of the CFPB.
Okay.
So since July 2011, we're going on 13 years now, we have had this government oversight body in place. And it is there to protect consumers against lenders who are unscrupulous, lenders who are predatory. And I want to circle back to my time in the mortgage industry to explain, well, how did we get to where we are? Why do we need a CFPB? The reason why we need a CFPB is because Wall Street was literally buying the most exotic mortgages that an originator could create and sell to a consumer. Now, by the way, if a mortgage lender could not sell that loan to a big Wall Street banker, they were not going to originate it, right? So it started at Wall Street. Wall Street said, hey, we love the mortgage industry. We love mortgages. We want more. And the lenders were like, well, we can't give you more because there's not that many people who qualify for more. And they said, well, let's loosen up the qualifications. Let's create alternative financing options.
Right.
And then we started creating alternative financing options. And they're like, wow, this is awesome. It's performing well.
Look at all the money I'm
Look
making.
at all the money I'm making. Give me more. We're like, there's not that many more home buyers who are qualified.
Find a way.
Yes. What if we got more exotic? And all of a sudden.
So give me an example of an exotic loan. Is this like a first-time home buyer down payment assistance rule? You UFMIP, like you qualify with a car and a tire? Like, give me an example.
Yeah. So like in a most basic term, let's just say traditional financing was I needed 2 pay stubs. I needed a 620 credit score. I needed 2 years of tax returns, 2 months of bank statements. And I had to make sure your debt to income ratio was below 45%.
Right.
And if it was, I can do a home loan for you as long as you're putting 3 to 3.5 to 5% down.
Okay.
Easy peasy mac and cheesy, but not fair to maybe the men and women that are like waiters and waitresses or bartenders that a lot of their money is tipped income, and man, they forget to report that tipped income on
every single year
on their tax return. Or it wasn't fair to that person who owned a small business, and because of the accounting practices that are allowed by the IRS, all of a sudden their taxable income went from $100,000 a year down to $20,000 a year because they took advantage of every tax loophole that was available to them. Made it hard to qualify. So then the industry was like, well, look, if you can't prove your income, but you're putting at least 20% down and you have at least a 700 credit score, we'll give you a loan, but instead of your rate being 5.5, it's going to be 6. Instead of you paying no points, you're going to pay 2 points. And those consumers were like, bro, I'd love to pay 6% and your 2 points, because I sure as hell don't want to go pay the IRS the $10,000 in taxes that I saved by writing off all the business expenses I wrote off because I'm self-employed. Or the waiter or the bartender is like, I would love to pay an extra $100 a month so that I don't have to pay an extra $300 a month by me not claiming my tips. So we came up with alternative A products that were basically, I need you to prove that you've been employed for the past 2 years. I need you to prove that you have enough money for your 20% down in your closing cost. I need you to prove you have a 700 credit score. But if you can do that and you're willing to take a higher rate, I don't mind not proving your income. Just state what you make. Okay, cool. We had a stated income loan. Easy peasy, like perfect. One thing led to another. And it's like almost playing that one-up game. Like we all have that friend that one-ups us. You know, you're like, oh man, like yesterday I was doing X And when I did that, not doing X like you like to do X, John.
Right. Please clarify.
Please clarify for our viewers. There's no Molly and there's no
I was doing X. I like where this is going.
Yeah, you got
perked up, right?
You perked up.
Oh, yeah.
No, how about this? It was like, oh yeah, so yesterday I was driving down the freeway and oh my gosh, I saw this motorcycle hit a truck and he did 2 flips over the truck and landed in the median. And your friend's like, oh, well, last month, I saw a motorcycle hit 2 trucks. The one truck flipped over 17 times, and the guy in the motorcycle landed on his feet. Then he jumped in the other truck, and they drove off together. You know, like there's always that person who one-ups you.
Yeah.
Whatever you say, whatever you've done, you talk about a cool vacation. They want to, I did the same vacation, except for we got VIP at the best club, and we flew on a PJ, right? To me, that's what a one-up is. Not doing X, by the way. All right. So back on my story. So if you are willing to do the 700 credit score 20% down, someone wanted to one up you. Oh, well, I'll do that same loan, but with only 10% down. Then someone else came and said, I'll do that same loan, 10% down, but a 660 credit score. And then it just became like, well, hold my beer. Hold my beer. Back and forth, back and forth, back and forth. Because all Wall Street wanted was more, more, more. I need to create more mortgages so I can create more collateralized debt obligations. I can then sell them to investors overseas. I can then sell them to life insurance companies. I can then sell them to pension funds. And that is how the bubble was created. It wasn't like there was a ton of demand for real estate. But once we made financing so accessible and so easy, and there was no oversight and there's no regulation, then all of a sudden we had a what would you call this? A demand that was abnormal. You had people that were buying homes that should have never been buying homes. You had originators putting people in home loans that were dangerous, all because Wall Street allowed it. And then one day the bubble burst. It's like any Ponzi scheme, any pyramid scheme. At some point, right, that house of cards are going to come falling down. So it came falling down. And I lived it. Like I was a young originator during this time. I was too young and naive looking back to really know what was going on.
Yeah.
I had to read Hank Paulson's book in order to truly understand, holy shit, that's what was going on behind me. Like I had to go watch the movie,
The Big Short.
The Big Short. I had to read the book, The Big Short, to be like, oh wow. Like some of The Big Short, I was like, yeah, I was there for it. And then others, I was like, oh my God, that's what was really happening. But all that was true. So the CFPB came about. So the reason why I don't think the CFPB is going to go away is first and foremost, like I'm the first that can stand up on my pedestal and I can bitch and complain about everything I dislike about the CFPB. Right now, I dislike the fact that I think they're sitting on their hands and letting the mortgage industry as a whole blatantly violate loan officer compensation rules. At which point I'm like, why do we have rules that we're not enforcing? Either don't have the rule, which is the way that I'd prefer it to be. If anyone ever know, where does Dustin Owen stand when it comes to LO comp? I want to go back to before July of 2010. I want to go before there's a Dodd-Frank Act, before there's a CFPB, and I want to go back to the day when the originator negotiated the rate and their commission with every single consumer that came by. I think that is actually the best free and fair market. I think the consumer ultimately wins. Unfortunately, in that situation, the consumer also puts themselves in a situation where they could be taken advantage of, and that's what was happening. So one of the good things that the CFPB did, it prevented anybody from being able to get taken advantage of as a borrower. And that's a really good thing because unfortunately, and Pareto's principle applies, 80% do good. They play by the rules. They are righteous and they are fair. It's the 20%. Those are the bad apples that ruin the bunch. So the CFPB came in with their rules and regulation and they're like, look, we have to protect the 20%. We have to protect from the 20%. We also have to protect the 20% that were maybe not getting a fair shake for whatever reason. So that's something good that the CFPB did. They also consolidated before like government oversight and regulation was fractionalized in all these different departments. And the CFPB came in, and at least the goal of it was to eliminate some of those government oversight departments and put it under one house, under one roof, under one director. And I think they accomplished some of what they set out to do, but they missed the mark on much other. But I don't want to see the CFPB go away because I think it does more good than it does harm, truly. Now, my issues, like I said, yes, I have issues. My issues is they tend to not have clear guidance. Therefore, they regulate through enforcement, and that's not fair. Like, to regulate through enforcement is essentially like me saying, hey, John, I need you to hop on the interstate and drive safely. That's all I said. Drive safely. Be a good driver, John. Make good choices. You made a great choice. You hopped on the interstate. You did 85 miles an hour. Woo, woo, woo. You get pulled over. Like, what are you doing? Well, you're driving reckless. Like, what are you talking about? I was driving reckless. Yes, you're doing 85 miles an hour, and 85 miles an hour is reckless. And you'd be like, well, says who? Well, says our rule book. Did you not see it? It says, please drive safe. You're like, no, you should have told me set a limit. Well, our interstates do that really well. We know there's a minimum miles per hour we have to drive, and there's a maximum that we're allowed to drive. So you have to go over 40 on the interstate, but you can't go over 80. Well, the CFPB did not do a good job and still does not do a good job of that. So the issue our industry, the mortgage industry, and most other industries have with the CFPB, it's not so much that they exist, it's that they exist and then how they enforce their rules. You know, they regulate through enforcement versus setting clear, concise boundaries. And then my bigger issues, and then when you have those clear, concise boundaries, then you regulate. And right now you have clear, concise boundaries on how mortgage brokers and mortgage bankers are compensated. And I'm telling you, the industry as a whole does not adhere to them, and you're not doing anything about it. Then it's just like, let's just do away with that regulation if you're not going to enforce it. Something else that I will tell you, and I kind of alluded to it, but I'll circle back. I have learned this from my industry, so I can only imagine how it applies to so many other industries. Regulation is a double-edged sword. I see its need. Its need is to protect the weak, the vulnerable, the uneducated, the inexperienced from those that control the power and the knowledge. It protects them from being taken advantage of. There's a certain part of me that enjoys knowing that there's a policing going on. That's why we have police in each city, in each county, in each state throughout the United States, is because we've recognized as a society we need some form of guardrails. I don't think any of us want to live in a police state, but we definitely want to have that access to some form of rules, regulation, and enforcement. Okay. What I don't like about regulation is it has taken the pain of a few and it spread it out amongst the masses. So we are protecting that those 2 in 12 that could potentially get a raw deal, and we're taking the pain that they would have felt by getting a raw deal. And by the way, they tend to get a raw deal because they're inexperienced, they're uneducated, right? They unfortunately called or were solicited by or filed an advertisement for someone who is an unscrupulous business person. But we're taking the pain that they would have felt and we're then just spreading it amongst the other 10. So it's like real life. 3 people could have negotiated an amazing deal. Trying to do my math in my head. 7 people negotiated a good deal. And 2 people got absolutely screwed over by their service provider. Instead of ever allowing 2 people to get screwed over by their service provider, what we're going to do is we're going to take the great deal away from the 3, and then we're going to spread the pain of the 2 amongst the 12, and now nobody gets a raw deal, but nobody gets a great deal. So all of a sudden, through regulation, what did the mortgage industry see? Their cost shoot up. So the cost to produce a loan has skyrocketed. And one of the many reasons is all of the regulatory hoops and the technology that we had to go out and create, purchase, and now follow added cost to our production assembly line. You would think if you ran a mortgage company, John, that you wouldn't want the CFPB. But at this point, you know what the mortgage industry is saying? This is coming out of the NBA. I'm sure if we sat down with Bob Broekschmidt with the NBA, he would probably echo something similar. He'd say it more eloquently than me, and he'd probably keep it more surface level. But he would say at this point, the industry thinks it's in our best interest to keep the CFPB because it would be so damn costly to unwind everything we've built and created over the past 13 years. Like the systems and the processes that we dumped hundreds of millions of dollars in, maybe even billions of dollars into, to just shit can it, to just toss it out the window, and to have to rebuild and recreate. No, thank you. No, thank you. This is the devil we know is better than the devil we don't know. Keep the CFPB. Now we can maybe strip away some of its power. Okay. We can maybe work with the CFPB to regulate differently. Like instead of enforcement through regulation through enforcement, maybe we can do things different. If there's certain regulations we don't like, maybe we can talk to them about rewriting that regulation. But to actually do away with it would actually be punitive for the mortgage industry, which is why my short answer to will Elon Musk successfully dismantle or shut down the CFPB? And my short answer is no. I think the answer is no, because the mortgage industry as itself, as a lobbying group, is going to be starchly against this, even though one would think it's in their best interest.
Why does old Twitter boy want to get rid of it?
He sees it as government waste. At the end of the day, he sees it as government waste. Now, if you and I wanted to go all Illuminati on this.
Yes, this is where I was hoping this would go. I know where this is going.
Look, if you are the rich people in power.
Yes, I want to stay that way.
You want to stay that way.
Yes. So strip away all the handicaps and guardrails that allow people that aren't like me to catch up. I don't want an even, fair race, Dustin.
Fact.
That's exactly what's happening.
Fact. And you can go back centuries. You can go back millennials, like millenniums.
Yeah.
And that is the world. That is the human civilization.
Right.
Those that are rich and powerful want to stay rich and powerful. Those that are rich and powerful want to help their friends and family also become rich and powerful. I mean, it's...
How much do you think the oversight, because the CFPB, you say, regulates all that stuff. Do you think Mr. Musk has his eyes, like, because of the mortgage industry? Like, how big of a pie is that? Or is he more worried about the bank regulations because that's a bigger pie?
It's bank regulations.
Okay.
It's the CFPB, it's the OCC, it's the FDIC. Like, there's other government regulatory bodies out there. And look, I'm no expert in the CFPB. I'm no expert in financial regulation. I know a thing or two because of what I do for a living. But yes, you would think that without the CFPB, do we throw Basel III out the window? And Basel III, and it's actually called Basel III Endgame, would have put some serious handcuffs on the financial and banking industry and the banking institutions, everything from like mortgage servicing rights to possibly, whether or not my bank can merge with your bank. Having X amount of market share could be a potentially bad thing. So, and there's always two sides of the coin. I'm sure there's an argument for deregulation, an argument for regulation. I tend to find in my life, somewhere in the middle lies the truth. It's kind of like when what I was trying to say with how I view regulation from the trenches. I have seen how it has protected the consumer. Nobody's getting screwed over. Like back in the day, there were loan originators that would quote you one thing, John. Then you'd get to the closing table and your fees were $3,000 higher. Your rate was 0.25% higher. And they literally said, well, then if you don't like it, don't sign the documents.
Don't sign it, lady.
And you're like, all my shit's in the moving truck. I've already broken my lease.
Looks like you're signing the document.
Looks like you're signing the document. Yeah, and they didn't care. Like that stuff actually happened. I talked to a buddy of mine that when he got in the industry, he said his first job as a mortgage lender in the early 2000s taught him everything not to do. his boss, his company, taught them to hand a good faith estimate to a consumer blank, have them just sign it, and then fill it in later.
That's how I got, that's how I got through middle school when I had to get progress reports signed.
You would just have your dad
I know
sign
my
a blank
mom.
one?
I know. I said, Mom, sign your name in cursive at the top of this piece of paper. She said, why? She says, I want to practice my cursive. And then I would take that note and then write in. That's genius. There's nothing wrong with that.
Okay, yeah, it's genius until it's taking advantage of people to the tunes of thousands of dollars.
Yeah, I just didn't want to.
Right, so like that part of the CFPB and regulation, that's good. Mm-hmm. Who doesn't want that, right? We want to protect a 2008 from ever happening again. We need some kind of oversight, like literally going to the ratings agency, sliding them a C note so they give you a AAA rating.
A lot of other countries.
No, that doesn't work. That's not. Then it's that rating agency is fake. It's a farce. It's false.
That's why
and
what,
none
Dustin,
of that matters.
We need you, because I'm gonna put a bow in this episode. Because if I don't, you're just gonna keep going forever. Jesus, we need to get you in office. We need someone like you, a man of integrity, a man of the people.
I tell you what. You know what?
Say
President-elect Trump.
Oh shit.
If you need a new director for the CFPB,
what if?
I will raise my hand today, and I will say I will come, and I will fall on that sword, and I would be the most middle of the road, do the right thing always. I can't be bought or purchased.
That's not
director of the CFPB.
Not how it works. But wouldn't that be some shit though? If like 3 weeks from now someone got a whiff of this and was like, I want him to be, and now you're reporting to Elon Musk instead of Dan Snyder. That's hilarious.
Yeah, no, but it's one of those things that I'll find a way to wrap it up because I will ramble for days and days on this topic. It's because of the CFPB, or Dodd-Frank, then the CFPB, then loan officer compensation rules, I will tell you the reason why mortgage loan originators make as much money per loan as they do today is because of regulation. Prior to regulation, when we were not regulating how much money an originator could make per loan, y'all averaged 55 to 60 basis points. Today, they average about 100 to 120 net. All my broker friends out there, I'm talking net after expenses, after your credit reports, after your split with your brokerage, after all the things that you have to pay for. The industry is averaging somewhere around 120 basis points net. It's double what it was prior to regulation. So for those in the industry that originate loans for a living, regulation was good for y'all. Like you doubled the percentage of what you made per loan. It did protect the consumer. The TRID and some of the new documents, although it was changed and I was like, damn, who moved my cheese? At the end of the day, most of it was better. Now, the facts, here's some of the facts. Has it saved money?
Hell no.
The CFPB?
No.
It has not saved money. Has it offered financial stability to the markets? Yes, it has offered financial stability to the markets. And has it protected the consumer? Yes. So if I look at what the CFPB has done, it has protected consumers. Check. It has provided financial stability to the markets. Check. Has it saved the consumer money? No. Has it cost the government money? I don't know. And I think that's what Elon and his Department of Government Efficiency is going to look into doing, is can they save the government by getting rid of the CFPB? I don't think he'll even make it that far because I don't think he's going to be able to actually shut down the CFPB. And I hope he doesn't. And it's not because I'm vying for Director Chopper's job. I'm not. But by the way, Trump, the Don, give me a call. I'd be interested in talking about it. But until then, I'm going to continue sitting at this desk in Orlando, Florida with my man, the new JC, making episodes like this.
Thank you. That was actually education. I don't know how long you were talking for, but I feel like
it was a long one, John.
I feel like I could learn, I could not regurgitate, but now I know what's going on because I don't subscribe to the news like you do.
Yep. No, but you should subscribe to our YouTube channel. You should sign up to our newsletter. Check out everything we're doing on tloponline.com. you should seriously consider investing in your business by hiring a business coach and a sales trainer. And that business coach and sales trainer can be us. All those details are found also at tloponline.com. Business planning, a free online workshop being hosted by yours truly, is December 12th. Register on the website, tloponline.com. We got Mortgage Con February 4th through 7th. Before Mortgage Con, which is in Orlando, Florida at Universal Studios, I'm going to go hang out with my friends at Eustis Mortgage. Eustis, New Orleans, Louisiana, I'm coming for you in January. Kentucky, we're coming for you in March. And Iowa, we're coming for you in April. His name is John Coleman. My name is Dustin Owen. You've just tuned in to the Loan Officer Podcast. That is all the time we have for you today, but we do look forward to catching you on the next episode. Peace.